All right, I think we're ready to get started.
All right. Well, good afternoon, everyone. Thank you for joining us today. Our 2023 flying by here, and the dog days of summer right in the midst. We're deep into it. Dog days of summer end is maybe, I don't know if everybody knows, but they go from July and early July to the end of August. Oh, not the end of August 11th is when it ends. So right in the midst of our session today, we're being the dog days of the summer. Last time Cliff and I were on the webinar with everybody or together was right as the kids were getting out of school. Now we're preparing to send those kids back. I know we're happy. My wife and I are ready to get our son back to school. Welcome, everyone. Thanks for joining us. We're going to go over our mid-year market update. I'm Jeff Carbone, certified financial planner, managing partner here at Cornerstone Wealth. As always, joined by my partner and our chief investment officer, keep calling you Chief, Cliff, but our chartered financial analyst, Cliff Hodge. Thanks, Cliff, for joining today, as always.
Thanks, Jeff. I've been called a lot worse than Chief, so I'll take it.
Well, Cliff, we're going to go over a lot today, as we always do, and it's certainly 2023, like many years, it's a little bit of a head scratcher. Especially as you know, a lot of the leading economic indicators that we follow have continued to deteriorate, but a few are still hanging on fairly strong. The main ones being the labor market and truck shipments have been pretty resilient, while everything else has been falling. The consumer, which again has been spending through that COVID built up money. Whether they've spent it or getting close to spending it all, it's pretty much getting close to being gone. So the consumer is starting to see some slowdown when you look at some of the not the things we need, but the things we want. We're starting to see some slowdown there. Of course, early part of the year, we had the banking issues with Silicon Valley Bank. We saw followed by the former First Republic, now JP Morgan, which JP Morgan took over basically for nothing. So they got that for a steal. We saw the Fed funds rate go up yesterday. So we're now Fed funds rate between 5.25% and 5.5%. So a lot of the questions out there, or a lot of the communication, news media, whatever, is soft landing possible? We're going to talk about that today. In addition, we'll go over the agenda being kind of just first a look back, and Cliff will take you back into the early part of the year, what's going on leading up to, end of June. We'll take a look back on the second half. We'll go over the Cornerstone dashboard, where we're seeing positive, the green signs, the caution of yellow, or the signs of red. We'll continue to go over the pillars of our investment process. So the fundamental, behavioral, we'll go over that. And then lastly, we're going to go over asset allocation and positioning. So as Cliff, again, a lot to go over, but as we do, I thought it'd be fun, share a couple quotes and see if everybody, maybe if people put it in the chat, tell me who you think this is. A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. Another great quote, it's never paid to bet against America. We come through things, but it's not always a smooth ride. And then maybe lastly, the stock market is a device for transferring money from impatient to the patient. So you tell me if you know who some of these quotes may have come through. Like I mentioned, Cliff's going to go over a lot of information today. And on behalf of the Cornerstone team, again, we thank you for joining. We're going to start doing a deeper dive, of course, but just a reminder, we are recording the session today, so it will be available later, maybe by Monday on our website. We'll post it to our Facebook page. We'll put it to the YouTube channel. We'll follow up with an email. So if you want to share it with friends, colleagues, family, please feel free to do so. Our mission, as always, is going to be, as your trusted advisors, provide the clarity and confidence as the cornerstone of your financial life. So Cliff, a lot to go over. Let's start and let's jump in. Let's do a look back to early part of the first half of 2023.
Yeah, thanks, Jeff. Great intro, great synopsis. I know at least one of those quotes is from the Oracle of Omaha, Mr. Warren Buffett. Not sure about the others, but great finds. I thought I'd just start by taking a step back and reviewing what we said coming into the year. Briefly review what has happened for the first half of 2023, and then finally turn our attention to what's more important into what the markets may have in store in the second half of the year and beyond. So coming into 2023, we really thought that both the economy and inflation would slow, and that the Fed would get near the end of their rate hike tightening cycle, and on the macro side, we've pretty much gotten that right. GDP has slowed on a year-over-year basis. Good solid numbers this morning from 2Q. Inflation has peaked and rolled over, and the markets are now pricing in that this most recent July hike was the last of the cycle. So we are pretty good on the macro front halfway through the year. We also thought that equities would have below average returns, and thus have been and were defensively positioned coming into the year. I'll say the S&P 500 has blown past our target. It's up about 17. The Dow is only up about 5. So if you have not been in the Magnificent Seven stocks, which we'll talk about here momentarily, the equity markets are kind of more in line with what we thought. We're only halfway through the year, so we will see what happens. Certainly from a dashboard perspective, using historical comparisons, the setup that we see now is certainly not conducive to being risk on. That's largely been the same, but we'll see. We'll see what happens. We've got some weakness today, and some things are changing on the margin. So we're going to talk about all that. We thought fixed income would be a pretty good year, kind of mid to high single digits. We're trending a little bit below that right now, up about 2.5 year to date in the ag. I think if the macro plays out the way we think it will over the second half, with the economy slowing, inflation slowing, we'll get a little bit more of a pickup from duration and yields peaking out. Same story with alternatives, kind of a little bit below where we thought they may be, but we still favor them over equities for the second half of the year. I'll start looking at returns. As I said, the S&P is up 17. These gray bars are what happened last year. Just as a reminder, it's been a ton of volatility. The S&P was down 18 last year. We have yet to eclipse the peak. We've been powering higher really the last 2 months. We've had some weakness today post Fed, so we'll see what that looks like. But as we've discussed, last year's losers, communication, discretionary, and information technology, are this year's winners. Really, with tech being the only group that have displaced their old highs, largely driven by the likes of these Magnificent Seven. If you've not been in those, if you've been in things like income, dividend paying stocks, value stocks, even momentum, you've had more of a average to below average year. If dividend payers are actually down, which is pretty interesting, and certainly not at, or certainly at odds with an S&P up 17. Just goes to show the sector concentration, or the individual concentration, as we'll see on this slide. So for those who have read our Cliff Notes, or had conversations with either myself or advisors, we've talked a lot about this concentration in Magnificent Seven, which are just 7 large cap AI-related growth stocks. You should all be familiar with these names. They've driven over 80% of the returns of the S&P 500 this year. So if you take the S&P 493 without these 7 stocks, you'd only be up about 4%, which is kind of what we thought coming into the year, and again in line with the Dow. So we don't own all these. We own a few of these in some of our stock portfolios, and as a result, we certainly have not gotten all of the upside of the S&P. Though, if you look at what has driven the rally, you really have 2 levers, right? You have earnings, or the fundamentals. You can measure that by expectations and earnings growth, earnings per share growth. or the price that you want to pay for those future earnings, which is measured by the valuation multiples or the PE ratios. So as you can see, if you look at these stocks where the PE was at the end of the year, where the PE is now, you can see there's been about a 50% increase in what investors are willing to pay for future earnings, while the actual earnings are flat or even down in some cases. So it's much harder to sustain an equity rally based on hope and expectations of things getting better if ultimately things don't come to fruition and match those lofty expectations. I think NVIDIA is probably the poster child. Big AI-related chip name has performed massively year to date, but now trades at 40 times revenue, 40 times sales. So if you think about what that means, if you invest in a company at 40 times sales, you are essentially saying it's going to take, for me to get paid back as an investor, paying that multiple, it's going to take 40 years. I'm going to have to get every single dime of sales that the company gets without, expenses, paying taxes, paying a dividend, running the actual business. It's possible that goes higher, but if history is a guide, it's certainly not a winning strategy. So certainly AI has been a narrative that has captured the attention of a lot of investors, especially retail investors. The other thing from a macro perspective is that so far through the first half of the year, some of these big indicators like inflation and like unemployment or the jobs market have pointed to really nice traction toward a soft landing narrative. And all a soft landing means is the ability to bring down inflation. This is core, this is headline in the white line, core in the yellow line. As you can see over time, we had the big spike. It is now coming back down toward the Fed's target of 2%. We want to see roughly 2% in core, so we still have a ways to go. Without unemployment, as here on the right-hand side of the chart, without it inflecting higher. Right, this is the COVID spike. As you can see, unemployment is hanging in there quite nicely. And so you get the combination of all the stimulus that we've talked about prior that has come in through COVID, the fact that inflation has come down while employment has remained low, and that has certainly gotten equity markets very excited about the prospects for a soft landing. So what we thought would be a good exercise is to actually go back and see what the emotional zeitgeist was at the time of the last three recessions. We didn't look at COVID. It was a little bit different, but we looked at 08, 07, 08 going into the global financial crisis, 2000 and .com, and then even back further, 1990 around Desert Storm. And you would think that some of these comments were taken from the Wall Street Journal today. Right, so you look at October 6, 2007, right at the top of the equity market. Friday's stock gains were fueled by unexpectedly strong employment report, suggesting that the economy has enough strength to avoid a recession. I don't know about you all, but I feel like I've heard or read something like that almost every day for the past 3 months. Same thing in 2000, after the peak, but before .com really took off. Economic data release continued to portray an economy gliding toward a soft landing of slower growth and stable prices. Again, sounds familiar. 1990, the economy generated many more jobs in February than analysts expected, suggesting a rebound. That was prior to the peak, but only about 4 to 6 months before the market ultimately topped and rolled over. And so it's certainly not uncommon for equity markets, especially who are the optimists, the equity investors are the optimists, to really latch on to what can go right until the data actually turns and you can kind of see the whites in the eyes, if you will. So what has surprised us? Obviously, we've not gotten everything right this year with strength in the equity markets, and I've been asked this question a few times, and so there's really three things that have surprised me. The first being liquidity. So we track this liquidity proxy in white. As you can see, this is 2022, 2023, as either the Fed or the Treasury have injected liquidity into the system, i.e. these white periods here, that has tended to coincide with bottoms in the equity markets. As liquidity has peaked and turned lower, that has seemed to coincide with at least local highs in the markets as well. Now, this was a lot of this is from the BTFP program when the regional banking crisis happened. This is from the Treasury General account. We don't have to go into all the details, but as you can see, liquidity has rolled over. The markets are still moving higher. So this has surprised us, right? That the equity markets have latched onto this. The second big surprise is the degree to which people have really gotten fired up about AI. It's a fantastic technology. We've already gotten a question about it in the queue, which we'll talk about at the end. We're bullish on AI for the long term. However, we think it's going to take some time for companies to figure out how to use it, for employees to get trained on it, understand what all the applications are before we see this, significant productivity boom that equity markets are pricing in. And then lastly, the third thing that has surprised us is just how strong the jobs market has been and continues to be. We'll look at some of the leading indicators of what the labor market is telling us now, but even this morning, we got a decrease in jobless claims compared to the run rate. Continuing claims as well continue to hold up very strongly. Even though a lot of these early sign, a lot of these leading indicators have rolled over, as Jeff mentioned. So Jeff, maybe I'll turn it back to you here before we look at the outlook.
Yeah. Cliff, I'm going to stay with your surprises, right? And this is not, this wasn't really, we weren't ready, but I took, before we got on, I pulled a email from Sean, one of the analysts, Ben Dazian, here in the office. And the other day when we were talking, we were looking at the S&P 500 top 12 holdings today versus the top 12 holdings 10 years ago. So still the number one holding, or the largest holding, was Apple today at 7.72% today. 10 years ago, it was still the number one holding, but 2.83%. Then we forget, when you look at the other holdings today, Microsoft 6.8, Amazon, NVIDIA, Alphabet, right? All a lot of technology. Companies back, just again, this is 10 years ago. The surprises that we have, companies like ExxonMobil was the number 2.77%. Johnson & Johnson, General Electric was in the top holding. Chevron, Microsoft, of course, Tesla wasn't even in the picture at that point, but Procter & Gamble, Wells Fargo was in the picture, no longer in the picture. So IBM, another, loved child, right? Gone. So the S&P makeup is really changed. So when you're going through and looking back, Cliff, it was some of the other surprises I was looking at was just the makeup of the S&P. What a change it's been in only 10 years of time. So thanks for doing, kind of taking us as a look back in the first half of the year. So let's kind of pivot towards, let's look at the outlook in the second half of the year here with some outlook and some key takeaways.
Yeah, thanks, Jeff. That was a great reminder. The world has changed quite a bit in such a short period, and I think AI is going to be a huge theme, certainly, but we're not going to pay 40 times sales to be able to participate in that here at the moment. We think we'll get there's other ways to do it. Certainly, better entry points as well, but always interesting to take a look back before we look forward. So. Glad you brought that up. So now moving forward, here are really the three key takeaways. Equities have rallied on the Goldilocks scenario, as we've shown. That we're going to spend a lot of time on these indicators. We're certainly getting a lot of questions about some of our positioning, what we're seeing. So I want to make sure that we cover all that and leave time for questions. We do think that this is likely the last rate hike of the cycle. There could be one more depending on what the inflation picture looks like going into the second half of the year. Maybe they do one in September, maybe November, but the bulk of it has been done. We think the heavy lifting on rates is done. And again, historically, when you look back at past cycles, really bullish for bonds, kind of in and around the last Fed rate hike. So we'll look at that. And then lastly, while there may be some more upside, momentum is strong. We're right in the midst of earnings season. kind of a mixed picture so far. You've had great results from names like Google and Meta, not so much from names like Microsoft, Tesla, Netflix. So we'll see still some big names to report, but if we do get some more further upside momentum, we think that's likely capped, really primarily because of valuations and where things are trading, especially when you compare PE multiples to interest rates. And what we think is going to be a bumpy second half of 2023. We still favor bonds and we still favor alternatives over stocks for now. So a quick update from our dashboard. Most clients should be familiar with this. This is just really a visual cue for our three-pronged investment process, which contain three subsets: the macro, the fundamental, and then the behavioral or the sentiment indicators. We still think we're late cycle going into recession. We thought, as we looked at the beginning of the presentation, we thought it may happen second half. Still could, but it's likely going to get pushed into 2024, it seems. The timing is a little bit of a wild card, especially given all of that excess savings, which we've talked about, that are still out there but are being spent down. Our quad setup is not favorable from a growth and inflation standpoint. We'll look at that. And the Federal Reserve is still tightening. Even if this is the last rate hike of the cycle, they are still doing quantitative tightening, or QT, in the background, where they are allowing treasuries to roll off of their balance sheet, which is, again, pulling liquidity from the system. From a valuation perspective, looking at PE ratios, we're above average. We could move into the expensive category. We'll see. Though earnings are falling and weakening, the expectation is that they inflect higher in the second half of the year. So one of two cohorts are wrong. Either the economists are wrong and we're going to inflect higher from a GDP standpoint, or the equity analysts are wrong and earnings expectations are going to have to come down. We're betting on the latter here currently. And then from a positioning standpoint, institutions continue to add to their positioning, but they're still historically underweight. Another reason why we could float up a little bit higher before we do hit some volatility. Though if you look at things like the options markets and what retail are doing, we measure the fear and greed index among a whole host of other indicators. They are all at extreme greed levels. Again, historically coincide with local equity market tops. I'll just run through this quickly. Again, late cycle in the U.S. and the developed markets going into recession overseas. China and Asia are interesting, coming out of a slowdown. We're keeping an eye on emerging markets. That's an area that we find interesting. On the lookout for additional stimulus measures out of China. I mentioned our quad model, growth and inflation. Just a quick review. GDP growth on the y-axis, inflation on the x-axis. Historically, periods of quad 4, also known as the Ice Age, are poor for risk assets. So, one of the other things that surprised us was the resiliency of the labor market, resiliency of the macro data. Coming into the year, we thought these quad 4 prints would hit earlier. Clearly, that has not been the case, but they are still forecast for 3Q, 4Q, and actually for 1Q24 as well. We just updated those models today, this morning. And so we do think it's a very high likelihood that the economy continues to slow alongside inflation here. So then let's look at some of the indicators that we track very closely, and again, historically have very tight relationships with not only the economy, but also with the S&P 500. The first of which is the Conference Board's Leading Economic Indicator Index, or also known as the LEI. So the LEI is comprised of 10 individual data points. We track those on month over month, year over year basis. The most recent reading came out in June, down roughly 8% year over year. Small sample size, but again, going back to the 80s, every time we've gotten to these levels, kind of below a -5, recession has happened. Only 3 samples, but again, historically, this is what happens when the economy slows and interest rates raise. People ask us about the soft landing, right? 94 being a great example of soft landing. Well, the LEI's barely contracted before rebounding, and far different setup than what we see today from that perspective. Credit. lifeblood of our capitalist economy. Business owners take out credit to open a business, to expand. It's very tough to have growth, especially in a levered economy and a mature economy without taking on credit. You look at what's happening at commercial banks, they're still lending, but it's obviously trending much lower. Again, these shaded bars are recessionary periods. As we see these steep drawdowns in credit, again, that's typically a sign that recession is around the corner. I'll call out 94 here again. That's a soft landing. Well, credit continued to flow all through 94, 95, not starting to contract until later time periods. So again, it takes time for these things to flow through, right? Especially when there's so much stimulus out there. But they're all pointing the same direction on a leading basis. Credit, by the way, this is lending, so this is credit. Just from a banking perspective, are you tightening standards for consumers? Are you tightening standards for C&I? So as these lines go higher, credit availability gets lower. It's harder to get a loan. You got to pay a higher rate. Has a perfect track record of forecasting recession. This is going back to 67. Red bars are recession. Some of these green bars here are soft landings. Again, I'll highlight 94. That's the one that everyone likes to point to. Credit was still loose. Banks were still making loans in 94. Not happening today. Again, every time we've gotten to these levels, a recession has followed, and so we're still not ready to wave the all clear flag. So when lending tightens up, interest rates rise, your cost of capital gets more expensive. You can't afford to pay back your debt. What do? You default. We're seeing a default cycle begin here as well. They bottomed in 2022. They've started inflecting higher. This is all corporates in green, high yield in blue. The market's not paying attention. The market doesn't care about the default cycle. They say, "Oh, it's normalizing." Well, it's possible, but typically these things don't just normalize and then stop. Especially in a lot of cases where these companies are going to see their financing costs double, if not triple. Bankruptcies. It's another one. Rising at the fastest pace since 2010. Certainly inflecting higher. You can see what this same pattern looked like back in 08. Obviously, we're not anywhere near 08. We don't think that's going to happen, even if we do hit a recession or a hard landing, if you want to call it that. But again, not a great sign. These credit's drying up. Companies are beginning to default on their bonds, and now bankruptcies are beginning to perk up as well. These things don't make us bullish on equities. The consumer accounts for roughly 70% of our GDP. We've talked a lot about how they have excess savings, dry powder to continue to spend. Well, this is a study from McKinsey that just got some credit and debit card data, some Amazon data. They compiled it both on a nominal basis and a real basis. So real just means you take the inflation piece out of it. Real retail sales have been negative for quite a bit. We now have had 2 months in a row. I'm sorry, has gone negative on a nominal basis for the first time in 2 years. Let me make sure I get that story straight. So retail, which has been the bedrock of the economy, is finally starting to slow, and we're seeing that in the data. So Cliff, you see all these data points. These are widely available. Why doesn't the market care about it? Well, it's a great question, and what we've come up with is that we think it's at this point, now that inflation has come down, going to be all about jobs, all about labor. So again, we've gone back and looked at previous periods, right? When we were in these late cycle pre-recessions, what was the thing that seemed to get the market's attention? And it was jobless claims, right? And so you're probably not going to be able to see this, but we'll circulate these slides. We'll make all these available on the website. But you've got the S&P here, and then you've got jobless claims actually inverted. So as the claims numbers go higher, so 300K a month seems to be kind of one of the magic numbers. When the claims numbers on this chart spike higher, i.e. they go lower, That's what seems to get the equity market's attention and be just a great coincident indicator. It's held up every time we've looked over these past 6 recessionary periods. As of now, the labor market continues to hold up, so equity markets can rally. However, when we look at things that, again, historically lead the employment cycle, not all well and good under the hood. We look at announced job cuts from Challenger. These are private job cuts. Fast forwarded 3 months. So you can see a very tight relationship between announced job cuts, jobless claims. Those have inflected higher. Claims have as well to a degree, but could potentially be more room. You look at breadth. So the number of states that have seen at least a 20% increase in jobless claims. We're at about 50% of states have seen jobless claims jump by 20%. So it's still somewhat contained, but as these move higher, obviously we would expect to see jobless claims inflect here a bit more. So we're kind of, again, I'll call out 94, kind of in line with 94. Perhaps this can turn lower. We'll see. Warn notices. We've talked about these before as well. When factories or large-scale employers are going to shut down a plant, for example, they're required to give 60 to 90 days notice to their employees. We've seen these warn notices ramp higher. Obviously, the claims numbers, you can see the correlations continuing to move up. Google searches for unemployment benefits. You can track Google searches these days, and it will give you information. Not as tight of a correlation, but still, you can see as these things ramp, typically the rate of change directionally, they move the same. And so, certainly a lot of indicators we're seeing. Again, they're leading. They take time to flow through the system. But again, using history as a guide, it would appear to us a pretty high likelihood that ultimately these things are going to manifest into the economy and then ultimately catch the attention of stock investors who are now paying 21, 22 times earnings. So Jeff, I'll pause there. And,
well, again, Cliff, a lot of data there, right, into what we're watching. When you go back to the dashboard, remaining in a more defensive position, because just taking those 9 data points, right, and then adding on additional, as I started the call with the resiliency of the labor market, starting to see some faltering, the credit and lending deterioration, delinquency, right, all these factors as to why, as we build and oversee the portfolios for everyone, defense is still paramount. And what are the old offense wins games, defense wins championships. Championships for our clients would be living that financial independent life that we all want and that our clients want, that you remain independent. We may not always hit the home run, and we're not trying to, but it's the defensive posture that we have that help us weather through these storms here and there. So Cliff, let's, big meeting yesterday with the Fed. So let's jump in and talk about the Fed. Yeah, very highly anticipated and watched meeting yesterday from the Federal Reserve, Bank of Europe today as well, or the ECB, European Central Bank, and then the Bank of Japan tomorrow. No shortage of a parade of central bankers this week, and really not anything that was too shocking. The market was expecting another 25 basis point rate hike. They fully delivered. They are going to remain data dependent. As you can see with what the market is pricing in now, here we are currently. There's a chance that you get a rate hike. Right now, it's only about a quarter of a 25% chance you get one more by the end of the year before you start cutting rates pretty dramatically in 2024. The market now pricing in roughly 4.5, 5 hikes next year. So typically when that happens, it's not because the Fed wants to moderate monetary policy and become dovish. It's because the macro or the economy has forced them to go the other way and start easing. And so, hey, Cliff, I think you said hikes, and I believe you meant cuts into next year.
Oh yeah, I'm sorry. Yeah, so cuts into next year. They don't cut rates this dramatically unless there's a problem. Is the gist of it. Sorry if I misspoke on that. So another interesting data point, we want to say, okay, well, what happens when the Fed finishes their tightening cycle, but doesn't yet start to cut rates? And the thing that really jumped out was that it's actually a great time for fixed income, especially the longer duration fixed income, right? We've gotten some questions about, well, hey, why do we want to buy anything but CDs if we're looking for income? Well, there's kind of two reasons. So one, while you are getting a little bit of a higher rate right now in a CD than you are in, say, a 10-year treasury, with a CD, you've got reinvestment risk, right? It's going to come due 9 months, a year, whatever the period is, then you have to reinvest that cash. Secondly, and most importantly, you do not get the benefit of falling interest rates from a price perspective, or that's what's known as duration, right? So with bonds, as interest rates fall, prices rise. And so not only do you get to compound your interest rate right now on a 10-year, I think it's 4. I think on the ag, you're looking at about a 4.5 yield, so 4.5% interest rate. And then what's known as about a 6 duration. So what that means is that if interest rates across the curve fall by 1%, you can expect that your bond prices will rise by 6%. So you take that 6 plus the 4 to 4.5 that you're compounding from your yield, and you're looking at potentially double-digit returns in treasuries, or the very highest credit quality bonds that there are out there. 9-10% is on par with equities, and you're not taking the risk, you're not paying the same multiple, and then you think about the likelihood. Well, if the Fed's done, is it more likely that rates move higher by 1%, or is it more likely that the economy slows and they fall, right? Our money is on rates peaking out and coming down, and so we really like the setup for fixed income. And we also like the setup for alternatives, which the ones that we're buying currently are going to benefit from high and falling interest rates as well. So we like those over equities. Historically, the peak in yields is about a month before the Fed finishes their rate hiking cycle. So the trough in returns around the same period. And then you look at longer periods out on the Treasury curve. Again, those tend to begin to come down. The curve begins to kind of normalize, right? Right now we're in this inverted curve. The curve begins to normalize about a month or two after the end of the hiking cycle. So we really like the setup for fixed income. You compare that to the fundamentals, the valuations for equities. This has actually even moved a little bit higher since we've updated this slide. We're at about 21 times next year's earnings on the S&P. Growth stocks up at 30 times earnings, pretty expensive. You can see that. Technology, consumer discretionary. Communications are a little wonky. That's a technical term because you have things like Meta, Google, Alphabet, Netflix, so on and so forth in the communications sector, along things like AT&T, Verizon, which have much lower price to earnings multiples. We talked about favoring international and emerging market stocks. You can see why here. If you look at the world ex-US, you're talking 13 times. That's quite a discount, roughly 35-40% discount to the S&P outside of the US. Same thing with emerging markets. So again, we favor the setup for equities outside the US rather than paying 30 times for growth stocks here at home. Bonds, again, we really like the setup with the interest rates that you're getting, but then also the duration pickup, or the ability to earn upside price return, as well as the interest rate that you're going to get. Spreads are still fairly tight. We do like EM from a fixed income standpoint. Those, typically you want to buy when these dots are above these blue lines. So we do continue to favor EM for some offense in our bond portfolios. But other than that, we are very happy to clip some coupon and high quality mortgage-backed, high quality corporates and treasuries as well. Last but not least, behavioral signals. Institutions are pretty well full boat into growth stocks. So hedge funds, large asset managers piled into the NASDAQ, a little bit underweight S&P, a little bit underweight the Dow, very short bonds. So that's going to be an interesting trade to see if we do get weakness and yields start to come in. It could exacerbate those moves. And then this is the star of the show here, the fear and greed index. We're pushing into this extreme greed category and have been there for quite a bit. And so again, the setup from a macro, from a fundamental, and from the behavioral standpoint, again, the three legs to our stool, if you want to think about it that way, point toward continuing to remain defensive, even in the eye of this blow off AI, growth-driven equity market rally in the S&P. So we've covered the asset allocation guidance throughout the call, but again, we favor fixed income and alternatives over equities. Not really high on growth stocks, kind of neutral value and defensive. We favor ex-US here, given the valuations and the setup overseas. We like aggregate bonds, so corporates and treasuries, mortgage-backed, high quality. And then we are in the alt space, not really high on return enhancers, so things like private equity that give you high upside, high downside, but really more these relative value, ARB, diversifying kinds of exposures, which again will do well to round out a portfolio, but then also work really well in an environment of high but falling, stable or falling interest rates. And so with that, Jeff, I will turn it back over to you. I want to thank everyone for joining today and spending time with us, listening to what we have to say. Certainly feel free to reach out to me anytime. I want to be a resource for anyone that may have questions or want to dive into specifics. And just thank you again for your time, attention, and dedication to Cornerstone. And we look forward to spending more time with you all going into the fall, if we can ever cool off this hot weather.
Well, again, thanks, Cliff. A lot of information. Again, I know it takes a lot of time to put this together. So again, appreciate some of those key takeaways here. Again, we're still believing inflation likely has peaked, although still staying higher than the Fed 2% target. And as you stated, still got a ways to come back, right? So if the target's 2 and we're 4.5, 4.8, where we're coming in, we've got a ways to recover to get back to that norm. The July meeting, as you mentioned, from the Fed, likely the closer to the end, with possibly being yesterday's rate hike, maybe the last, although we're continuing to watch what may take place there, which again, as you showed us just in a couple slides ago, historically on a bullish sign on the bond side, as rates do kind of hit to that higher cycle. We're still remaining more defensive. Again, in the light of all that's going on, still not seeing this as it's an all clear time to move back in heavy. Doesn't mean we get out of equities, right? The type of equities still remain more defensive. Healthcare, we still hold technology, more higher quality defensive technology. We still hold energy. We still hold financials, although higher quality, bigger names. We're not looking for the regional banks. We're looking, if we're going to be in the defensive area for the financials, let's hold the big ones that, i.e., as I mentioned, who get really good deals like a JP Morgan, Goldman, right? We're going to hold the ones that weather through this with us. So again, thank you, Cliff, again, for sharing all that. Again, the information that you put together. You also talked about the Mag 7, the Magnificent 7. What a difference 2022 to 2023. When we looked at if you took a Tesla, you took an NVIDIA, you took even an Apple, all stocks that were down 30+%, 40%, 50% in many cases. Right now we're seeing that rebound, which again, not outside of maybe a few still not hitting their highs. Maybe Nvidia is one of the ones, one of the few that has gone blow through it. Seeing a lot of optimism in the bout of the fear, as you showed us, the extreme greed, right? The extreme greed, because the FOMO is kicked in, the fear. What did I miss? What am I missing? I got to jump on now. Guess what happens? And we were talking earlier, right? We're ending July here, entering the two worst months of the year, August and September. August has historically been one of the worst months of the year. And be careful of jumping in at the wrong time. It's balanced. It always will be a balanced portfolio. That's how you weather through this. That's how you stress test the portfolios. That's how we stress test our portfolios. We'll continue to remain resilient in making adjustments as the Fed has, with watching Fed movements, where the Fed funds rate is. Are we at the height of the cycle, or what will we need to adjust if there is another rate increase? Making some adjustments as needed. Watching inflation, watching the volatility, the sector dispersion. We'll be, as an investment team, as your financial advisors, as your financial team, that's what we're watching behind. So as we close out the session, as I started, our children, grandchildren, the younger generations getting back to school. I wanted to share a little bit. I was watching, and I'm not sure if everybody that's here, as we finish up, any Yellowstone fans from the TV show with Kevin Costner. And I've become a fan. I've watched it a few times, but I was taking a quote from Beth Dutton, great actress. What a interesting person to watch. But I was watching in one of the episodes. She was saying to the young man that she was taking care of, if you want nice things, there's three ways to get it. You inherit it, and we can certainly help people with inheritance. You can steal it. We don't recommend, nor do we help people like that. Or you can work really, really hard. You fail. You learn from the failure. You may fail again, but don't let anyone outwork you. It's a good reminder that success is achieved and is never given. So as we sign off, thanks, Cliff, for your time. Thanks for the energy you put behind this. We thank you all. We appreciate the trust and confidence you've placed in the Cornerstone team and continue to place in us. Keep an eye out for the email. So if you want to share it with friends, family, coworkers, send it on. Let us know how we can help you in any way. As always, we wish you health, wealth, and happiness. Have a great rest of the half. We'll be back probably sometime, I would say, in October as we close out 2023. Have a great day, everyone.